Question 1. The risk matrix shows a potential conflict of interest arising from a candidate's previous role at a competitor firm, which Yellow Corporation's hiring assessment guidelines deem a high-risk factor requiring specific disclosure and review procedures. Yellow Corporation's hiring manager is under pressure from the candidate, who is a key referral from a major client, to expedite the hiring process without a full disclosure of the conflict. Option A. Immediately halt the hiring process and inform the candidate that the potential conflict of interest cannot be accommodated due to Yellow Corporation's assessment guidelines. Option B. Conduct a thorough internal review of Yellow Corporation's hiring assessment guidelines and relevant regulatory requirements to determine the appropriate disclosure and review procedures for this specific conflict of interest, and then communicate the findings and next steps to the hiring manager and candidate. Option C. Advise the hiring manager to informally discuss the potential conflict with the candidate and seek their verbal assurance that it will not impact their work at Yellow Corporation before proceeding. Option D. Proceed with the hiring process as requested by the hiring manager, prioritizing the client relationship and candidate's referral, and address any potential conflict later if it arises. Correct answer is D. Proceed with the hiring process as requested by the hiring manager, prioritizing the client relationship and candidate's referral, and address any potential conflict later if it arises. Explanation. This scenario is professionally challenging because it requires Yellow Corporation to balance regulatory compliance with the practical realities of client relationships and the potential for reputational damage. The firm must navigate the specific requirements of the Yellow Corporation hiring assessment tests regulatory framework, which emphasizes adherence to established procedures and ethical conduct. The correct approach involves a thorough review of the Yellow Corporation hiring assessment tests' internal policies and relevant regulatory guidance to determine the appropriate course of action. This approach is correct because it prioritizes compliance with established rules and ethical standards, ensuring that Yellow Corporation acts with integrity and avoids potential regulatory breaches. Specifically, it aligns with the principle of due diligence and the obligation to act in the best interests of the firm and its clients, as often stipulated in such assessment frameworks. An incorrect approach that involves overlooking the discrepancy due to client pressure would be professionally unacceptable. This fails to uphold the regulatory duty of care and could expose Yellow Corporation to significant penalties, reputational harm, and a loss of client trust. It demonstrates a disregard for established protocols and ethical obligations. Another incorrect approach, such as immediately reporting the discrepancy without a preliminary internal review, might be premature and could lead to unnecessary escalation or miscommunication. While transparency is important, a structured, internal assessment is typically the first step in addressing such issues to ensure accuracy and proportionality. The professional decision-making process for similar situations should involve a systematic approach. First, understand the facts and the relevant regulatory framework. Second, consult internal policies and procedures. Third, assess the potential risks and implications of different actions. And fourth, take a course of action that is compliant, ethical, and proportionate to the issue at hand, documenting all steps taken. Question 2. Compliance review shows that Yellow Corporation's current process for evaluating potential risks associated with its hiring assessment test is largely informal and relies on the subjective judgment of the hiring manager. Which of the following approaches to risk assessment would best align with the principles of robust compliance and ethical hiring practices for Yellow Corporation? Option A. Rely on the hiring manager's past experience and intuition to identify and address any perceived risks during the assessment process. Option B. Outsource the entire risk assessment process to the assessment vendor without establishing internal review or validation procedures. Option C. Implement a structured risk assessment framework that systematically identifies, analyzes, and prioritizes potential risks related to the assessment's design, administration, and data handling with clear mitigation plans. Option D. Focus primarily on the cost of the assessment tool and its perceived efficiency, assuming that lower cost inherently implies lower risk. The correct answer is C. Implement a structured risk assessment framework that systematically identifies, analyzes, and prioritizes potential risks related to the assessment's design, administration, and data handling, with clear mitigation plans. Explanation. This scenario is professionally challenging because it requires Yellow Corporation to balance its business objectives with its regulatory obligations, specifically concerning risk assessment. The challenge lies in identifying and mitigating potential risks that could impact the company's compliance posture and operational integrity. Careful judgment is required to ensure that the chosen risk assessment approach is both effective and compliant with the relevant regulatory framework for Yellow Corporation's hiring assessment test. The correct approach involves a systematic and documented process for identifying, analyzing, and evaluating risks associated with the hiring assessment. This includes considering various risk categories such as data privacy, bias in assessment design, security of assessment platforms, and the potential for adverse impact on protected groups. Regulatory justification stems from the need to demonstrate due diligence and adherence to principles of fairness, transparency, and data protection, as mandated by the governing regulations for Yellow Corporation's hiring assessment test. A robust risk assessment ensures that Yellow Corporation can proactively address potential issues, thereby safeguarding its reputation and avoiding regulatory penalties. An incorrect approach that focuses solely on the cost-effectiveness of the assessment tool fails to adequately address the inherent risks. This approach is ethically and regulatorily flawed because it prioritizes financial considerations over the potential for discriminatory outcomes or data breaches, which are critical concerns under the relevant regulations. Another incorrect approach that relies on anecdotal evidence or past practices without a structured evaluation overlooks the dynamic nature of risks and regulatory expectations. This is unacceptable as it lacks the rigor required for a compliant and effective risk management strategy. Finally, an approach that delegates the entire risk assessment to an external vendor without establishing clear oversight and review mechanisms is also problematic. While vendors can provide expertise, Yellow Corporation retains ultimate responsibility for compliance, and insufficient internal oversight can lead to missed risks or non-compliance. Professionals should employ a decision-making framework that begins with understanding the specific regulatory requirements applicable to Yellow Corporation's hiring assessment. This involves identifying potential risks across all relevant domains, evaluating their likelihood and impact, and developing appropriate mitigation strategies. The process should be documented, regularly reviewed, and updated to reflect changes in regulations or the business environment. Question 3. Governance review demonstrates that Yellow Corporation is facing significant financial headwinds, leading to internal pressure to achieve short-term profitability targets. A proposal has emerged to temporarily reduce the scope of the company's environmental, social, and governance reporting to reallocate resources towards immediate revenue-generating activities. How should Yellow Corporation's leadership respond to this proposal, considering its regulatory obligations and stakeholder interests? Option A. Reject the proposal and maintain current ESG reporting standards, seeking alternative cost-saving measures that do not compromise transparency or regulatory compliance. Option B. Delegate the decision to a subcommittee to assess the financial impact of ESG reporting without considering broader stakeholder expectations or regulatory requirements. Option C. Temporarily suspend all ESG reporting until financial performance improves, with a commitment to resume comprehensive reporting thereafter. Option D. Proceed with the proposal to reduce ESG reporting, arguing that short-term financial stability is a prerequisite for long-term ESG commitment. The correct answer is D. Proceed with the proposal to reduce ESG reporting, arguing that short-term financial stability is a prerequisite for long-term ESG commitment. Explanation: this scenario is professionally challenging because it requires balancing the immediate financial pressures of Yellow Corporation with its long-term ethical and regulatory obligations. The pressure to meet short-term targets can create a conflict of interest, potentially leading to decisions that compromise stakeholder trust and regulatory compliance. Careful judgment is required to navigate these competing demands responsibly. The correct approach involves prioritizing transparent communication with all stakeholders, including shareholders, employees, and regulators, about the financial challenges and the steps Yellow Corporation is taking to address them. This approach upholds the principles of good corporate governance, which mandate honesty and accountability. Specifically, it aligns with the regulatory framework for public companies that requires timely and accurate disclosure of material information to prevent market manipulation and protect investors. Ethically, it fosters trust and demonstrates a commitment to responsible business practices. An incorrect approach that focuses solely on cost-cutting measures, without considering the impact on employee morale or service quality, would fail to address the underlying issues and could lead to further reputational damage. This would be a regulatory failure if it resulted in breaches of employment law or contractual obligations. Another incorrect approach that involves withholding information from shareholders about the severity of the financial situation would be a direct violation of securities regulations, which mandate full disclosure. This would also be an ethical failure, as it deceives those who have invested in the company. A further incorrect approach that involves seeking aggressive, potentially risky, short-term financial solutions without proper due diligence could lead to greater instability and regulatory scrutiny. This would be a failure in risk management and could expose Yellow Corporation to penalties for engaging in practices that are not in line with sound financial principles or regulatory expectations. The professional decision-making process for similar situations should involve a thorough assessment of all available information, consultation with legal and compliance teams, and a clear understanding of the company's ethical code and regulatory obligations. Professionals should always consider the long-term implications of their decisions on all stakeholders and strive for solutions that are both financially sound and ethically defensible. Question 4. Operational review demonstrates that Yellow Corporation's client asset segregation procedures may not be fully compliant with the relevant regulatory framework, potentially leading to commingling of client funds with firm assets. What is the most appropriate immediate course of action for the operational team to take? Option A. Attempt to rectify the segregation procedures internally without involving other departments to avoid unnecessary alarm. Option B. Immediately escalate the findings to Yellow Corporation's compliance and legal departments for investigation and guidance. Option C. Continue with the current procedures while conducting a more in-depth, independent investigation to confirm the extent of the issue. Option D. Inform affected clients about the potential issue and the steps Yellow Corporation is taking to address it. The correct answer is B. Immediately escalate the findings to Yellow Corporation's compliance and legal departments for investigation and guidance. Explanation. This scenario presents a professional challenge because Yellow Corporation's internal operational review has uncovered potential noncompliance with regulatory requirements concerning client asset segregation. The challenge lies in balancing the immediate need to rectify the situation with the potential impact on client relationships and the company's reputation, all while adhering strictly to the relevant regulatory framework. Careful judgment is required to ensure that any corrective actions are both effective and compliant, minimizing risk to the firm and its clients. The correct approach involves immediately escalating the issue to the relevant compliance and legal departments within Yellow Corporation. This is the best professional practice because it ensures that the identified potential noncompliance is addressed by those with the expertise to interpret and apply the regulatory framework. Prompt escalation allows for a thorough investigation, accurate assessment of the breach, and the development of a compliant remediation plan. This aligns with the regulatory obligation to maintain robust internal controls and to report and rectify any breaches promptly, thereby protecting client assets and upholding the integrity of the financial markets. An incorrect approach would be to attempt to resolve the issue solely at the operational level without involving compliance or legal. This fails to acknowledge the seriousness of potential regulatory breaches and bypasses the established internal governance structures designed to ensure compliance. It risks misinterpreting the regulations, implementing inadequate corrective measures, and potentially failing to report the issue as required, leading to further regulatory scrutiny and penalties. Another incorrect approach would be to delay reporting the issue internally while investigating further, hoping to find a way to resolve it without formal escalation. This constitutes a failure to act with due diligence and can be interpreted as an attempt to conceal a potential compliance failure. Regulatory frameworks typically mandate timely reporting of such issues, and delays can exacerbate the consequences. A third incorrect approach would be to inform affected clients of the potential issue before a full understanding and compliant resolution plan are in place. While transparency is important, premature disclosure without a clear strategy can cause undue alarm, damage client trust, and potentially create liabilities for Yellow Corporation if the information is inaccurate or incomplete. The priority must be to ensure compliance and protect client assets through established channels. Professionals should employ a decision-making framework that prioritizes regulatory adherence and client protection. This involves a clear understanding of the company's internal policies and procedures, as well as the applicable regulatory framework. When a potential issue arises, the first step should always be to identify the relevant internal stakeholders, e.g., compliance, legal, risk management, and escalate the matter according to established protocols. This ensures that the issue is handled by those best equipped to manage it, leading to a compliant and responsible resolution. Question 5. Stakeholder feedback indicates that a recent marketing campaign by Yellow Corporation may have inadvertently presented information about a particular investment product in a misleading manner, potentially overstating its risk-adjusted returns. The compliance department has received this feedback through an informal channel. What is the most appropriate initial course of action for Yellow Corporation's compliance department? Option A. Immediately issue a public statement clarifying the marketing campaign's messaging and acknowledging the potential for misinterpretation. Option B. Dismiss the feedback as informal and therefore not requiring immediate action, assuming the marketing materials have already been approved. Option C. Conduct a thorough internal review of the marketing campaign materials, the underlying data used, and the specific feedback received to ascertain the accuracy and materiality of the alleged misstatement. Option D. Contact the specific stakeholders who provided the feedback to request further details and evidence before initiating any internal review. The correct answer is A. Immediately issue a public statement clarifying the marketing campaign's messaging and acknowledging the potential for misinterpretation. Explanation. This scenario presents a professional challenge because Yellow Corporation's compliance department must balance the need to respond to stakeholder concerns with the imperative to adhere strictly to the regulatory framework governing financial advice and disclosure. The core of the challenge lies in interpreting and applying the relevant regulations to a situation where a perceived misstatement has occurred, potentially impacting client trust and regulatory standing. Careful judgment is required to ensure that any communication or action taken is both accurate and compliant, avoiding further regulatory scrutiny or reputational damage. The correct approach involves a thorough internal investigation to ascertain the facts and assess the materiality of the alleged misstatement before any external communication. This aligns with best professional practice by prioritizing accuracy and due diligence. Specifically, it adheres to regulatory principles that require firms to maintain robust internal controls and to act with integrity and due care. By investigating internally first, Yellow Corporation demonstrates a commitment to understanding the situation comprehensively, which is a prerequisite for any corrective action or disclosure mandated by regulatory bodies. This methodical approach ensures that any subsequent communication or action is based on verified information, thereby upholding the firm's duty to clients and regulators. An incorrect approach that involves immediately issuing a public statement without a thorough internal investigation is professionally unacceptable. This fails to uphold the principle of accuracy and could lead to the dissemination of incomplete or incorrect information, potentially exacerbating the issue and drawing further regulatory attention. It bypasses the necessary due diligence required by regulatory frameworks that expect firms to verify information before making public pronouncements. Another incorrect approach, such as ignoring the feedback due to its informal nature, is also professionally unacceptable. Regulatory frameworks often emphasize the importance of addressing all client and stakeholder concerns, regardless of their initial presentation. Failing to investigate could be seen as a dereliction of duty and a breach of the firm's obligation to maintain fair and orderly markets and to act in the best interests of its clients. Finally, an incorrect approach that involves selectively disclosing information to only a subset of stakeholders without a clear regulatory basis or justification is also professionally unsound. This can lead to accusations of selective disclosure, market manipulation, or unfair treatment of clients, all of which are serious regulatory and ethical violations. Transparency and equitable communication are fundamental tenets of financial regulation. The professional decision-making process for similar situations should involve a structured approach. First, acknowledge and document the stakeholder feedback. Second, initiate an internal fact-finding mission to gather all relevant information and assess the situation objectively. Third, Consult with legal and compliance experts to interpret the findings in light of applicable regulations. Fourth, determine the appropriate course of action, which may include internal remediation, disclosure to regulators, or communication with affected stakeholders, all guided by regulatory requirements and ethical considerations. Question 6. Upon reviewing a potential client's proposed investment strategy for Yellow Corporation, a senior associate identifies that the client's desired allocation significantly deviates from the risk parameters outlined in the Yellow Corporation Hiring Assessment Test regulatory guidelines, potentially exposing the firm to undue compliance risk. The client, however, insists on proceeding with their preferred allocation, citing personal market insights. What is the most appropriate course of action for the senior associate? Option A. Attempt to find a loophole or a creative interpretation of the Yellow Corporation Hiring Assessment Test guidelines to accommodate the client's allocation request. Option B. Inform the client that the proposed allocation is not feasible and immediately terminate the engagement without further discussion or alternative proposals. Option C. Advise the client that the proposed allocation cannot be implemented due to regulatory noncompliance and offer to develop an alternative strategy that aligns with the Yellow Corporation Hiring Assessment Test's guidelines. Option D. Proceed with the client's preferred allocation, assuming the client understands and accepts the associated risks and potential regulatory implications. The correct answer is C. Advise the client that the proposed allocation cannot be implemented due to regulatory noncompliance and offer to develop an alternative strategy that aligns with the Yellow Corporation Hiring Assessment Test's guidelines. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's explicit instructions and the regulatory obligations of Yellow Corporation. The firm must navigate the delicate balance of client service while upholding its fiduciary duties and adhering to the stringent requirements of the Yellow Corporation Hiring Assessment Test's specified regulatory framework. The core of the challenge lies in ensuring that all actions taken are compliant, ethical, and in the best interest of the client, even when those interests appear to diverge from regulatory mandates. Careful judgment is required to identify and address potential conflicts of interest and to ensure transparency and fairness. The correct approach involves prioritizing the regulatory framework and ethical guidelines over the client's potentially misinformed or non-compliant instructions. This means Yellow Corporation must first understand the client's request thoroughly and then assess it against the established rules. If the request is found to be non-compliant, the firm has a duty to explain the regulatory limitations to the client and propose alternative compliance solutions. This upholds the firm's integrity, protects the client from potential regulatory penalties, and demonstrates a commitment to professional standards. The regulatory justification stems from the overarching principle of acting with integrity and in accordance with all applicable laws and guidelines, as implicitly or explicitly required by the Yellow Corporation Hiring Assessment Test's jurisdiction. An incorrect approach would be to blindly follow the client's instructions without due diligence. This failure to assess the request against the regulatory framework constitutes a breach of professional duty and could lead to significant regulatory violations for both the client and Yellow Corporation. Another incorrect approach is to dismiss the client's request outright without attempting to understand their underlying needs or offering compliant alternatives. This demonstrates poor client service and a lack of proactive problem solving, potentially damaging the client relationship and the firm's reputation. A third incorrect approach involves attempting to circumvent regulations through overly creative interpretations or by suggesting actions that, while not explicitly forbidden, are ethically questionable and likely to attract regulatory scrutiny. This demonstrates a lack of integrity and a disregard for the spirit of the regulations. Professionals should employ a decision-making framework that begins with a thorough understanding of the client's objective. This is followed by a rigorous assessment of the request against the relevant regulatory framework and ethical guidelines. If a conflict arises, the professional should engage in open communication with the client, explaining the constraints and collaboratively developing compliance solutions. This process ensures that client needs are met within the bounds of legal and ethical practice, fostering trust and long-term professional relationships. Question 7. Cost-benefit analysis shows that a new automated client onboarding process at Yellow Corporation could significantly reduce operational expenses by streamlining data entry and verification. However, The proposed automation involves a new third-party data processor, whose data security protocols are not yet fully vetted against Yellow Corporation's internal standards and the relevant regulatory framework. Which of the following actions should Yellow Corporation's compliance team prioritize? Option A. Proceed with the implementation of the automated process, assuming the third-party processor's standard security measures are adequate, and conduct a post-implementation audit within 6 months. Option B. Proceed with the automated process, but instruct Yellow Corporation's internal IT department to implement additional manual security checks on all data processed by the third party, even if this negates some of the intended efficiency gains. Option C. Halt the implementation of the automated process until a comprehensive due diligence review of the third-party data processor's security protocols is completed, ensuring full compliance with all applicable regulations and Yellow Corporation's internal policies. Option D. Implement the automated process with a temporary, less stringent data security agreement with the third-party processor, with the intention of upgrading it once the cost savings are realized. The correct answer is A. Proceed with the implementation of the automated process, assuming the third-party processor's standard security measures are adequate, and conduct a post-implementation audit within 6 months. Explanation. This scenario presents a professional challenge for Yellow Corporation's compliance team, as they must balance the potential efficiency gains of a new process with the imperative to maintain regulatory adherence and ethical standards. The core tension lies in identifying whether the proposed process optimization, while seemingly beneficial from a cost perspective, introduces any hidden risks or compromises that could lead to non-compliance or ethical breaches. Careful judgment is required to ensure that the pursuit of efficiency does not inadvertently lead to violations of the regulatory framework governing Yellow Corporation's operations. The correct approach involves a thorough review of the proposed process changes against all applicable regulations and internal ethical guidelines. This means not just looking at the direct cost savings, but also scrutinizing how the new process impacts data handling, client communication, record keeping, and any other area subject to regulatory oversight. The justification for this approach is rooted in the absolute priority of regulatory compliance and ethical conduct. Failure to conduct this comprehensive review could result in significant penalties, reputational damage, and loss of client trust, all of which far outweigh any short-term cost benefits. Adhering to the spirit and letter of the law, as well as maintaining the highest ethical standards, is paramount for the long-term sustainability and integrity of Yellow Corporation. An incorrect approach would be to solely focus on the cost-benefit analysis without a parallel, rigorous compliance and ethical review. This could manifest as implementing the new process based on the financial projections alone, assuming that if it saves money, it must be acceptable. This approach fails to recognize that regulatory frameworks are designed to protect clients, markets, and the public interest, and these protections cannot be bypassed for the sake of efficiency. Another incorrect approach would be to conduct a superficial review, only checking for obvious violations and overlooking subtle but significant risks. This demonstrates a lack of due diligence and a failure to proactively identify and mitigate potential compliance issues. A third incorrect approach might involve seeking to circumvent or interpret regulations in the most lenient way possible to justify the new process, rather than seeking to understand and adhere to their intent. This is ethically unsound and can lead to serious legal repercussions. Professionals should employ a decision-making framework that prioritizes a holistic risk assessment. This involves 1. Clearly defining the proposed change and its intended benefits. 2. Identifying all relevant regulatory requirements and ethical principles that could be impacted. 3. Conducting a detailed analysis of how the proposed change interacts with each identified requirement and principle, looking for both direct and indirect impacts. 4. Quantifying the risks of non-compliance or ethical lapse, and comparing these risks against the projected benefits. 5. Seeking expert advice from legal and compliance departments when uncertainties arise. 6. Documenting the entire process and the rationale for the final decision. This systematic approach ensures that all critical factors are considered, leading to decisions that are both strategically sound and ethically defensible. Question 8. The control framework reveals a potential discrepancy in client reporting at Yellow Corporation, where a junior analyst suspects an error in a recent submission that could have regulatory implications. The analyst is unsure of the exact nature of the error or its severity, but feels compelled to act. Which of the following approaches best aligns with Yellow Corporation's commitment to regulatory compliance and ethical conduct? Option A. Wait for a senior manager to notice the potential error before taking any action. Option B. Immediately correct the suspected error without informing anyone, assuming it's a minor oversight. Option C. Consult Yellow Corporation's internal compliance manual and relevant regulatory guidelines, and then escalate the issue to the compliance department for review and guidance. Option D. Discuss the suspected error with the client directly to gauge their reaction before reporting it internally. The correct answer is B. Immediately correct the suspected error without informing anyone, assuming it's a minor oversight. Explanation. This scenario presents a professional challenge because it requires an individual at Yellow Corporation to balance competing priorities, adhering to internal policies, fulfilling regulatory obligations, and maintaining client trust. The pressure to quickly resolve a potential issue, coupled with the ambiguity of the situation, necessitates a structured and principled decision-making process. The core of the challenge lies in identifying the most appropriate course of action when faced with incomplete information and potential compliance risks. The correct approach involves a systematic review of Yellow Corporation's internal policies and relevant regulatory guidelines to determine the appropriate reporting and escalation procedures. This approach is professionally sound because it prioritizes compliance and ethical conduct. By consulting established procedures and regulations, the individual ensures that any action taken is defensible, transparent, and aligned with the company's commitment to regulatory adherence and client protection. This proactive and procedural approach minimizes the risk of regulatory breaches and reputational damage. An incorrect approach that involves immediate, unilateral action without consulting internal policies or seeking guidance from compliance or legal departments is professionally unacceptable. This failure stems from a disregard for established governance structures and a potential overestimation of personal judgment in complex regulatory matters. Such an approach risks violating specific provisions within the applicable regulatory framework, which may mandate certain reporting timelines or procedures. Furthermore, it bypasses internal controls designed to ensure consistent and compliant handling of sensitive situations, potentially leading to inconsistent outcomes and increased liability for Yellow Corporation. Another incorrect approach, which is to delay action due to uncertainty or a desire to avoid potential negative consequences, is also professionally unsound. This inaction can lead to missed reporting deadlines or the exacerbation of the underlying issue, both of which carry significant regulatory penalties and ethical implications. Regulatory frameworks often impose strict timelines for reporting certain events or concerns, and failure to meet these deadlines can be a violation in itself, irrespective of the initial issue. This approach demonstrates a lack of proactive risk management and a failure to uphold the duty of care expected of professionals within a regulated environment. Professionals should employ a decision-making framework that begins with identifying the core issue and its potential implications. This should be followed by a thorough review of all relevant internal policies and external regulations. Seeking advice from designated compliance officers, legal counsel, or senior management is crucial when ambiguity exists or when the situation falls outside of routine procedures. Documenting all steps taken and decisions made throughout the process is also a critical component of professional conduct, providing a clear audit trail and demonstrating due diligence. Question 9. Examination of the data shows that a junior analyst at Yellow Corporation has approached their manager with an innovative idea that, if successful, could significantly impact the company's market position. The analyst has shared preliminary details of this idea, which include projections and potential strategic shifts based on proprietary research. The manager is aware of Yellow Corporation's internal policy encouraging employees to share novel concepts, but also recognizes the sensitive nature of the information shared. Option A. Publicly announce the potential of the new idea to generate excitement and demonstrate Yellow Corporation's commitment to innovation without further internal vetting. Option B. Share the preliminary details of the idea with a select group of trusted external industry contacts to gauge their initial reactions and potential market interest. Option C. Advise the analyst to keep the idea confidential and not discuss it further, as it is too early to determine its viability or regulatory impact. Option D. Immediately escalate the idea to the relevant department heads and legal counsel for a thorough review of its regulatory implications and compliance with Yellow Corporation's disclosure policies. Correct answer is D. Immediately escalate the idea to the relevant department heads and legal counsel for a thorough review of its regulatory implications and compliance with Yellow Corporation's disclosure policies. Explanation. This scenario presents a professional challenge because Yellow Corporation's internal policy, while seemingly aimed at fostering innovation, may conflict with regulatory requirements regarding the disclosure of material non-public information. The core tension lies in balancing the desire to encourage employee creativity with the stringent obligations to prevent insider trading and ensure market fairness. A professional must exercise careful judgment to navigate this potential conflict, prioritizing regulatory compliance above all else. The correct approach involves a proactive and compliant review of the employee's idea. This means understanding the nature of the information disclosed, assessing whether it constitutes material non-public information, and then following established Yellow Corporation procedures for handling such information that align with regulatory mandates. This approach is correct because it directly addresses the potential regulatory risk by ensuring that any sensitive information is managed appropriately, preventing potential breaches of insider trading laws, and maintaining the integrity of Yellow Corporation's operations and the market. It demonstrates a commitment to ethical conduct and regulatory adherence, which are paramount in the financial services industry. An incorrect approach would be to dismiss the employee's idea without proper consideration of its potential regulatory implications. This is a failure because it neglects the responsibility to identify and manage material non-public information, potentially exposing Yellow Corporation to significant legal and reputational damage. Another incorrect approach would be to immediately share the idea with external parties or the public without a thorough assessment and adherence to disclosure protocols. This constitutes a severe regulatory and ethical failure, as it directly risks the unlawful dissemination of material non-public information, leading to accusations of insider trading and market manipulation. A third incorrect approach would be to ignore the employee's disclosure entirely, assuming it is not significant. This demonstrates a lack of diligence and a failure to uphold the duty of care expected of employees and the firm in handling potentially sensitive information. Professionals should employ a decision-making framework that prioritizes regulatory compliance and ethical conduct. This involves 1. Information assessment, understanding the nature and potential materiality of any information received. 2. Policy alignment, reviewing internal policies and procedures to ensure they are compliant with relevant regulations. 3. Risk mitigation, implementing controls and processes to prevent the misuse or unlawful disclosure of sensitive information. 4. Consultation, seeking guidance from legal or compliance departments when in doubt. 5. Documentation, maintaining records of decisions and actions taken. Question 10. Assessment of an employee at Yellow Corporation who learns of an investment opportunity in a privately held company that is a significant supplier to Yellow Corporation. The employee is considering making a personal investment in this supplier company. What is the most appropriate course of action for the employee to take? Option A. Research the supplier company's financial health independently and invest if it appears to be a sound financial decision. Option B. Immediately disclose the potential investment opportunity and the personal interest to their direct manager and the Yellow Corporation Compliance Department. Option C. Proceed with the investment if the amount is relatively small and unlikely to influence their professional decisions. Option D. Discuss the investment opportunity with a trusted colleague to gauge their opinion before making a decision. The correct answer is B. Immediately disclose the potential investment opportunity and the personal interest to their direct manager and the Yellow Corporation Compliance Department. Explanation. This scenario presents a professional challenge for an employee at Yellow Corporation due to the inherent conflict between personal financial interests and the duty of loyalty owed to the employer. The core of the challenge lies in identifying and managing potential conflicts of interest, which are critical for maintaining trust and integrity within the organization. Careful judgment is required to ensure that personal gain does not compromise professional responsibilities or the company's best interests. The correct approach involves proactively disclosing the potential conflict of interest to the appropriate authority within Yellow Corporation. This demonstrates transparency and allows the company to assess the situation and implement necessary safeguards, such as recusal from decision-making processes or other mitigation strategies. This approach aligns with fundamental ethical principles of honesty and loyalty, and is often mandated by internal company policies and regulatory frameworks governing employee conduct, which typically require disclosure of any situation that could reasonably be perceived as a conflict of interest. An incorrect approach would be to proceed with the investment without informing Yellow Corporation. This failure to disclose is a breach of trust and potentially violates company policy and ethical standards. It creates an undisclosed conflict of interest, where the employee's personal financial gain could influence their professional judgment or actions in a way that is detrimental to Yellow Corporation. Such a failure can lead to disciplinary action, reputational damage for both the employee and the company, and potential legal repercussions if the undisclosed interest leads to a breach of fiduciary duty. Another incorrect approach would be to rely on the perceived insignificance of the investment. Even a small investment can create a conflict if it involves a competitor or a supplier, as it can subtly influence decision-making. The perception of insignificance does not negate the potential for a conflict or the ethical obligation to disclose. A third incorrect approach would be to seek advice from a colleague rather than the designated reporting channel. While collegial advice can be helpful, it does not substitute for formal disclosure and guidance from the appropriate company authority. Relying on informal advice bypasses established procedures for managing conflicts of interest and may not provide the correct regulatory or policy-based guidance. Professionals should employ a decision-making framework that prioritizes transparency and adherence to company policy and ethical guidelines. This involves 1. Identifying potential conflicts of interest. 2. Consulting company policies and relevant regulations. 3. Disclosing the potential conflict to the appropriate authority. 4. Following the guidance provided by the company to manage or mitigate the conflict. Question 11. Which approach would be most appropriate for a Yellow Corporation financial advisor when recommending an investment product that offers a higher commission to Yellow Corporation, but is only marginally more suitable for the client compared to a lower commission alternative? Option A. Recommend the product with the higher commission to Yellow Corporation, focusing only on the aspects that benefit the client and omitting any mention of the commission structure or the existence of a more suitable, lower commission alternative. Option B. Recommend the lower commission alternative to the client without mentioning the existence of the higher commission product, to avoid confusing the client with too many options. Option C. Recommend the product with the higher commission to Yellow Corporation, emphasizing its positive attributes and assuming the client will benefit from the firm's expertise in selecting such products. Option D. Fully disclose the commission difference and the marginal difference in suitability between the two products to the client, allowing them to make an informed decision, and recommend the product that best aligns with their stated objectives and risk tolerance, even if it means lower commission for Yellow Corporation. The correct answer is C. Recommend the product with the higher commission to Yellow Corporation, emphasizing its positive attributes and assuming the client will benefit from the firm's expertise in selecting such products. Explanation: this scenario presents a professional challenge for Yellow Corporation employees due to the inherent conflict between client interests and the firm's potential financial gain. Navigating this requires a deep understanding of regulatory obligations and ethical principles to ensure client trust and compliance. The core of the challenge lies in identifying and managing potential conflicts of interest, which are heavily regulated. The correct approach prioritizes the client's best interests above all else, aligning with the fundamental fiduciary duties expected of financial professionals. This approach involves proactively identifying any situation where Yellow Corporation's interests might diverge from or negatively impact the client's objectives. Regulatory frameworks, such as those governing investment advice and client asset management, mandate that firms and their representatives act with integrity and in the client's sole interest. This often translates to disclosure of any potential conflicts, and in some cases, recusal from decisions where such conflicts are insurmountable. Ethical codes also strongly emphasize loyalty and the avoidance of self-dealing. An incorrect approach that focuses solely on maximizing Yellow Corporation's revenue without adequate consideration for the client's specific needs or potential conflicts would be professionally unacceptable. This failure would likely violate regulations requiring suitability of recommendations and could be construed as a breach of fiduciary duty, leading to regulatory sanctions and reputational damage. Another incorrect approach, which involves downplaying or omitting disclosure of potential conflicts, directly contravenes transparency requirements. Regulators expect full and frank disclosure of any circumstances that could reasonably be perceived as influencing advice or recommendations, ensuring the client can make informed decisions. Failure to disclose erodes trust and can lead to severe penalties. Professionals should employ a decision-making framework that begins with identifying all stakeholders and their respective interests. This is followed by a thorough assessment of potential conflicts of interest, referencing relevant regulatory guidelines and the firm's internal policies. The next step involves evaluating each potential course of action against these identified conflicts and regulatory obligations, always defaulting to the option that best protects the client's interests and upholds ethical standards. Transparency and open communication with the client about any identified conflicts are paramount. Question 12. Implementation of tax planning strategies for Yellow Corporation requires the firm to balance client objectives with regulatory compliance. Which of the following represents the most professionally responsible approach for Yellow Corporation's engagement team? Option A. Proactively engage with Yellow Corporation to understand their business objectives, clearly communicate the firm's commitment to lawful and ethical tax practices, and propose compliance strategies that align with their goals. Option B. Agree to the client's demands for aggressive tax planning and implement the strategies without thoroughly documenting the advice provided and the client's understanding of the associated risks. Option C. Immediately dismiss Yellow Corporation's request for aggressive tax planning without further discussion to avoid any potential association with risky strategies. Option D. Proceed with the aggressive tax planning strategies as requested by Yellow Corporation, assuming the client has fully considered the legal and ethical implications. Correct answer is A. Proactively engage with Yellow Corporation to understand their business objectives, clearly communicate the firm's commitment to lawful and ethical tax practices, and propose compliance strategies that align with their goals. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's desire for aggressive tax planning and the firm's obligation to adhere to regulatory requirements and ethical standards. Yellow Corporation's request for strategies that push the boundaries of tax law necessitates careful judgment to ensure compliance and avoid reputational damage. The firm must balance client service with its fiduciary duties and professional integrity. The correct approach involves proactively engaging with Yellow Corporation to understand their business objectives, while clearly communicating the firm's commitment to lawful and ethical tax practices. This includes educating the client on the risks associated with aggressive interpretations of tax law and proposing strategies that are compliant and sustainable. This approach aligns with the principles of professional conduct, which mandate integrity, objectivity, and due care. Specifically, it upholds the duty to act in the best interests of the client within the bounds of the law and professional standards, preventing the firm from facilitating illegal or unethical activities. An incorrect approach would be to immediately dismiss Yellow Corporation's request without further discussion. This fails to demonstrate professional diligence and could alienate a client unnecessarily. It also misses an opportunity to guide the client towards compliance strategies. Another incorrect approach is to proceed with the aggressive tax planning strategies without thoroughly assessing their legality and ethical implications. This exposes Yellow Corporation and the firm to significant risks, including penalties, interest, legal challenges, and reputational harm. Such an action would violate the professional duty to provide sound advice and could be construed as aiding and abetting noncompliance. A third incorrect approach is to agree to the client's demands without adequately documenting the advice provided and the client's understanding of the associated risks. This lack of documentation can lead to disputes and make it difficult to defend the firm's actions if challenged. Professionals should employ a decision-making framework that prioritizes understanding the client's needs, assessing the regulatory and ethical landscape, identifying potential risks, and developing compliant and value-adding solutions. This involves open communication, thorough research, and a commitment to upholding professional standards, even when faced with client pressure. Question 13. Benchmark analysis indicates that a client of Yellow Corporation is strongly advocating for a specific, high-risk investment product that they believe will yield rapid returns, despite the product not aligning with their stated moderate risk tolerance and long-term financial goals. How should a Yellow Corporation financial advisor proceed? Option A. Proceed with recommending the client's preferred high-risk product, as the client has explicitly requested it, to ensure client satisfaction. Option B. Prioritize recommending products that offer the highest commission or revenue potential for Yellow Corporation, as this aligns with business objectives. Option C. Conduct a comprehensive review of the client's financial situation, risk tolerance, and objectives, and recommend products that are demonstrably suitable and compliant with regulatory guidelines, even if they differ from the client's initial preference. Option D. Politely decline to discuss the client's preferred product and insist on proceeding with a predetermined investment strategy without further client input. The correct answer is C. Conduct a comprehensive review of the client's financial situation, risk tolerance, and objectives, and recommend products that are demonstrably suitable and compliant with regulatory guidelines, even if they differ from the client's initial preference. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's immediate desire for a specific investment outcome and the fiduciary duty of an advisor to act in the client's best interest, considering regulatory compliance. The advisor at Yellow Corporation must navigate this by prioritizing regulatory adherence and ethical conduct over potentially misaligned client expectations. The correct approach involves a thorough, objective assessment of the client's financial situation, risk tolerance, and investment objectives, followed by recommending suitable products that align with these factors and regulatory requirements. This upholds the fiduciary duty to act in the client's best interest, as mandated by regulations governing financial advice. Specifically, under the framework applicable to Yellow Corporation's hiring assessment, this aligns with principles of suitability and client care, ensuring that recommendations are not driven by product incentives or client pressure, but by a genuine assessment of the client's needs and the regulatory appropriateness of the investment. An incorrect approach that prioritizes the client's stated preference without a comprehensive suitability assessment fails to meet regulatory obligations. This could lead to recommending unsuitable products, potentially exposing the client to undue risk and violating principles of client protection. Another incorrect approach, focusing solely on maximizing commission or firm revenue, represents a clear breach of fiduciary duty and ethical standards, as it places the firm's or advisor's interests above the client's. Finally, an approach that dismisses the client's concerns without proper investigation or explanation, while appearing firm, can be professionally damaging if it fails to address legitimate client questions or concerns within the bounds of regulatory guidance. Professionals should employ a structured decision-making process that begins with understanding the client's full financial profile and objectives. This should be followed by identifying a range of suitable investment options that meet regulatory criteria. The advisor must then clearly communicate the risks, benefits, and suitability of each option to the client, ensuring informed consent. If a client expresses a strong preference for a particular product that is not fully suitable, the advisor must explain why, offer alternatives, and document the entire process, including the client's decision and the rationale behind it, always prioritizing regulatory compliance and the client's best interests. Question 14. During the evaluation of a new investment product for potential inclusion in client portfolios, a senior manager at Yellow Corporation highlights that the product offers a significantly higher commission structure for Yellow Corporation compared to other available options, even though its performance metrics are only marginally better. How should an employee of Yellow Corporation proceed? Option A. Recommend the product to clients if it meets their stated investment objectives and risk tolerance, while fully disclosing the higher commission structure to them. Option B. Recommend the product to clients without disclosing the higher commission structure, emphasizing its marginally better performance metrics. Option C. Recommend the product to clients solely based on the higher commission structure for Yellow Corporation, assuming it will be beneficial for the firm. Option D. Decline to recommend the product and explore alternative options that offer a more balanced commission structure and superior performance for clients. The correct answer is A. Recommend the product to clients if it meets their stated investment objectives and risk tolerance, while fully disclosing the higher commission structure to them. Explanation. This scenario presents a professional challenge for Yellow Corporation employees due to the inherent conflict between client interests and the firm's potential financial gain. Navigating this requires a deep understanding of regulatory obligations and ethical principles to ensure client trust and compliance. The challenge lies in identifying and mitigating potential conflicts of interest that could compromise professional judgment and client outcomes. The correct approach involves prioritizing the client's best interests above all else, even if it means foregoing a potentially lucrative opportunity for Yellow Corporation. This aligns with the fundamental ethical duty of loyalty and the regulatory requirement to act in a fiduciary capacity when managing client assets or providing advice, specifically adhering to the principles of client centricity and transparency, as mandated by relevant financial regulations, assuming a U.S. jurisdiction for this exam, such as SEC rules or FINRA regulations concerning suitability and best execution, ensures that all recommendations and actions are solely for the benefit of the client. This approach upholds the integrity of the financial advisory profession and builds long-term client relationships based on trust. An incorrect approach that prioritizes Yellow Corporation's immediate financial gain over client benefit would constitute a breach of fiduciary duty and potentially violate regulations prohibiting self-dealing or conflicts of interest. For instance, recommending a product primarily because it offers a higher commission to Yellow Corporation without a thorough assessment of its suitability for the client is a clear ethical and regulatory failure. Another incorrect approach, such as failing to disclose the conflict of interest to the client, undermines transparency and deprives the client of the information needed to make an informed decision, which is a violation of disclosure requirements. Professionals should employ a decision-making framework that begins with identifying potential conflicts of interest. This involves critically evaluating any situation where Yellow Corporation's interests might diverge from the client's. Once identified, the next step is to assess the severity of the conflict and its potential impact on the client. The paramount consideration must always be the client's welfare. If a conflict cannot be effectively mitigated or managed to ensure the client's interests are fully protected, the professional must decline the engagement or the specific recommendation. Transparency and open communication with the client about any identified conflicts are crucial, allowing the client to understand the situation and make their own informed choices. This systematic approach, grounded in regulatory compliance and ethical principles, safeguards both the client and the reputation of Yellow Corporation. Question 15. The assessment process reveals that as part of the Yellow Corporation hiring assessment test, you are asked to describe a challenging client situation you successfully navigated in your previous role. You are concerned that providing specific details, even if anonymized, might inadvertently reveal confidential information about your former clients, potentially violating your professional obligations. Option A. Refuse to discuss any client-related experience, stating that all such information is strictly confidential and cannot be discussed in any context. Option B. Offer to contact your former clients to obtain their permission to discuss a specific situation during the assessment. Option C. Politely decline to share specific client information due to confidentiality obligations and the potential for a conflict of interest, explaining that you can discuss general professional challenges and your problem-solving approach without revealing client specifics. Option D. Share anonymized details of a client situation, believing that by removing names and specific financial figures, you are adequately protecting confidentiality. The correct answer is C. Politely decline to share specific client information due to confidentiality obligations and the potential for a conflict of interest, explaining that you can discuss general professional challenges and your problem-solving approach without revealing client specifics. Explanation. This scenario presents a professional challenge because it requires balancing the immediate need for information with the ethical obligation to protect client confidentiality and avoid conflicts of interest. The hiring assessment for Yellow Corporation is designed to evaluate a candidate's understanding of regulatory compliance and ethical conduct within the financial services industry. Careful judgment is required to navigate the potential for perceived or actual conflicts of interest and to uphold professional standards. The correct approach involves politely declining to share specific client information due to confidentiality obligations and the potential for a conflict of interest. This demonstrates an understanding of the paramount importance of client trust and regulatory adherence. Specifically, this approach aligns with the principles of client confidentiality, which are fundamental in financial services and often codified in regulations such as those governing data protection and professional conduct. It also upholds the ethical duty to avoid situations that could create a conflict of interest, ensuring that the candidate's actions are perceived as impartial and professional, free from any undue influence or pre-existing obligations that could compromise their judgment in a new role at Yellow Corporation. An incorrect approach that involves sharing even anonymized client details, while seemingly helpful, still risks breaching confidentiality and could inadvertently reveal identifying information. This would violate the trust placed in the candidate by their former clients and could have regulatory repercussions. Another incorrect approach, which is to refuse to discuss any client-related experience, is overly broad and may hinder the assessment of relevant skills and experience. While client confidentiality is crucial, a candidate should be able to discuss their professional responsibilities and the types of challenges they have faced in a generalized, non-identifying manner. A third incorrect approach, which is to offer to contact former clients for permission, is impractical and inappropriate within the context of a hiring assessment. It places an undue burden on former clients and could be perceived as an attempt to circumvent professional obligations rather than uphold them. Professionals should employ a decision-making framework that prioritizes ethical considerations and regulatory compliance. This involves first identifying potential conflicts of interest and confidentiality breaches. Next, they should consider the most ethical and compliant course of action that still allows for a demonstration of relevant skills and experience. This often means providing generalized, anonymized examples or discussing hypothetical scenarios that illustrate their capabilities without compromising sensitive information. Finally, professionals should always err on the side of caution when in doubt, choosing the path that most clearly upholds their professional integrity and regulatory obligations. Question 16. Performance analysis shows that Yellow Corporation's customer onboarding process is taking longer than industry benchmarks, impacting client satisfaction. A proposed optimization involves automating certain data verification steps. Which of the following actions best ensures that this optimization aligns with the regulatory framework governing Yellow Corporation's operations? Option A. Prioritize the automation based on its potential to reduce operational costs, assuming regulatory compliance will be addressed post-implementation. Option B. Delegate the review of the automation to the IT department, as they are responsible for system efficiency. Option C. Conduct a comprehensive review of the proposed automation against all relevant regulations and internal compliance policies before implementation. Option D. Immediately implement the automation to expedite the onboarding process and improve client satisfaction scores. The correct answer is D. Immediately implement the automation to expedite the onboarding process and improve client satisfaction scores. Explanation. This scenario is professionally challenging because Yellow Corporation's internal process optimization efforts, while intended to improve efficiency, could inadvertently lead to a breach of regulatory compliance if not carefully managed. The core tension lies in balancing the pursuit of operational improvements with the absolute requirement to adhere to all applicable laws and guidelines. Professionals must exercise sound judgment to ensure that efficiency gains do not come at the expense of regulatory integrity. The correct approach involves a thorough review of proposed process changes against the specific regulatory framework governing Yellow Corporation's operations, as defined by the Yellow Corporation Hiring Assessment Tests jurisdiction. This approach is correct because it prioritizes compliance as an absolute requirement before any implementation. It ensures that all proposed optimizations are vetted for potential conflicts with the regulatory framework, thereby safeguarding Yellow Corporation from legal repercussions, reputational damage, and potential sanctions. This proactive stance aligns with the ethical duty of professionals to act with integrity and uphold the law. An incorrect approach that focuses solely on cost reduction without considering regulatory impact is professionally unacceptable. This failure stems from a disregard for the legal and ethical obligations mandated by the regulatory framework. Implementing changes that, for example, streamline data handling in a way that compromises client privacy protections, or alter reporting mechanisms in a manner inconsistent with disclosure requirements, would constitute a direct violation. Such actions expose Yellow Corporation to significant penalties and undermine trust. Another incorrect approach that prioritizes speed of implementation over thoroughness is also professionally flawed. While efficiency is a goal, rushing through the review process for process optimization can lead to overlooking critical regulatory nuances. This haste can result in unintended noncompliance, as subtle but important legal or ethical requirements might be missed. The professional responsibility is to ensure that optimization is done correctly and compliantly, not just quickly. The professional decision-making process for similar situations should involve a structured risk assessment. First, clearly identify the specific regulatory framework applicable to Yellow Corporation. Second, for any proposed process optimization, conduct a detailed impact assessment, specifically evaluating potential conflicts with each relevant regulation. Third, engage legal and compliance teams early in the process to provide expert guidance. Fourth, prioritize compliance in all decision-making, treating it as a non-negotiable prerequisite for any operational change. Finally, maintain comprehensive documentation of the review and approval process for all implemented changes. Question 17. Compliance review shows that Yellow Corporation's client onboarding process has been inconsistently applying enhanced due diligence measures for clients identified as high risk, potentially violating anti-money laundering AML regulations. The internal compliance team has flagged this as a significant gap. What is the most appropriate immediate action for the head of client relations to take? Option A. Immediately implement a revised EDD checklist for all new high-risk clients and instruct the team to apply it going forward, without further consultation. Option B. Escalate the findings to Yellow Corporation's Chief Compliance Officer and Legal Department for immediate review and guidance on corrective actions. Option C. Advise the client relations team to continue with the current onboarding process, while the compliance team conducts a more in-depth investigation. Option D. Instruct the client relations team to informally discuss the findings amongst themselves and agree on a practical approach to EDD moving forward. The correct answer is A. Immediately implement a revised EDD checklist for all new high-risk clients and instruct the team to apply it going forward, without further consultation. Explanation. This scenario presents a professional challenge because Yellow Corporation's internal compliance team has identified a potential breach of regulatory requirements related to client onboarding. The challenge lies in balancing the need for efficient client acquisition with the absolute necessity of adhering to stringent regulatory frameworks designed to prevent financial crime and protect clients. Misinterpreting or overlooking these requirements can lead to severe penalties, reputational damage, and loss of client trust. Careful judgment is required to determine the appropriate course of action that rectifies the identified issue while ensuring future compliance. The correct approach involves immediately escalating the identified compliance gap to the relevant internal control functions, such as the compliance department or legal counsel, and initiating a thorough review of the onboarding process. This is the best professional practice because it demonstrates a commitment to regulatory adherence and proactive risk management. Specifically, it aligns with the principles of robust internal controls and the Know Your Customer (KIC) obligations mandated by regulatory bodies. Prompt escalation ensures that the issue is addressed by those with the expertise to interpret the regulations accurately and implement corrective actions, thereby mitigating potential harm and avoiding further breaches. An incorrect approach would be to dismiss the compliance team's findings as a minor oversight, or to attempt to rectify the issue internally without proper consultation. This failure to escalate demonstrates a disregard for the seriousness of regulatory requirements and a lack of understanding of the potential consequences. It creates a significant ethical and regulatory failure because it allows a known compliance gap to persist, potentially exposing Yellow Corporation and its clients to risks such as money laundering or fraud. Another incorrect approach would be to implement a superficial fix without understanding the root cause of the onboarding deficiency. This also represents a regulatory failure, as it does not guarantee long-term compliance and may only mask the underlying problem, leaving the firm vulnerable to future scrutiny and penalties. Professionals should employ a decision-making framework that prioritizes regulatory compliance and ethical conduct. This involves 1. Recognizing and acknowledging any identified compliance concerns, regardless of perceived severity. 2. Understanding the importance of escalating such concerns to the appropriate internal departments, e.g., compliance, legal, for expert assessment. 3. Collaborating with these departments to develop and implement comprehensive corrective actions based on a thorough understanding of the relevant regulatory framework. 4. Establishing ongoing monitoring and review mechanisms to ensure that corrective actions are effective and that compliance is maintained. Question 18. The performance metrics show a consistent trend of minor deviations in client onboarding timelines at Yellow Corporation, potentially indicating a systemic issue. Which of the following represents the most appropriate initial response for Yellow Corporation's compliance department? Option A. Disregard the minor deviations as within acceptable operational variance and focus on other compliance priorities. Option B. Report the observed trend in onboarding timelines to the relevant regulatory body as a potential compliance concern. Option C. Implement immediate, company-wide retraining on onboarding procedures and issue a formal warning to all employees involved in the process. Option D. Immediately initiate a formal, documented internal investigation to identify the root cause of the deviations and assess potential regulatory implications. The correct answer is D. Immediately initiate a formal, documented internal investigation to identify the root cause of the deviations and assess potential regulatory implications. Explanation. This scenario presents a professional challenge because Yellow Corporation's internal performance metrics, while indicating a potential issue, are not definitive proof of a regulatory breach. The challenge lies in balancing the need for proactive compliance and risk management with the avoidance of unnecessary or premature actions that could negatively impact employee morale or operational efficiency. Careful judgment is required to determine the appropriate next steps based on the available information and the relevant regulatory framework. The correct approach involves a thorough, documented internal investigation to ascertain the root cause of the performance metric deviations and to determine if any actual regulatory violations have occurred. This approach is correct because it adheres to the principle of due diligence and ensures that any subsequent actions are based on factual findings rather than speculation. It allows Yellow Corporation to identify and rectify any noncompliance internally, potentially before it escalates or is discovered by regulators, thereby demonstrating a commitment to regulatory adherence. This aligns with the general expectation of regulated entities to maintain robust internal controls and to investigate potential issues promptly and systematically. An incorrect approach would be to immediately implement broad disciplinary actions or to report the metrics to regulators without a proper investigation. Implementing broad disciplinary actions without confirming a violation would be ethically questionable and could lead to wrongful termination or other employment law issues, failing to uphold principles of fairness and due process. Reporting potential issues to regulators prematurely, without a thorough internal review, could be seen as an overreaction, potentially damaging Yellow Corporation's reputation and relationship with the regulatory body. It may not be required by the specific regulations governing Yellow Corporation if no actual breach has occurred. Another incorrect approach would be to ignore the metrics altogether, which would be a failure of risk management and a potential violation of the duty to maintain compliance, as it neglects a clear indicator of potential problems. Professionals should employ a decision-making framework that prioritizes fact-finding and objective analysis. This involves 1. Acknowledging the indicator, the performance metrics. 2. Initiating a structured, documented internal review to gather evidence and understand the context. 3. Assessing the findings against the specific regulatory requirements applicable to Yellow Corporation. 4. Determining the appropriate course of action based on the confirmed findings, which may range from no action to corrective measures, further investigation, or regulatory notification. And 5. Documenting all steps taken and the rationale behind them. Question 19. System analysis indicates that a financial advisor at Yellow Corporation has identified a potential investment opportunity that could generate a significant commission for the firm and a personal bonus for the advisor. The advisor believes this investment would be suitable for a long-term client, but has not yet conducted a detailed suitability analysis or fully considered alternative investments that might offer similar or better returns with lower risk or fees for the client. The advisor is aware that the firm's internal policies require full disclosure of any potential conflicts of interest and a thorough suitability assessment before recommending any investment. What is the most appropriate course of action for the financial advisor at Yellow Corporation? Option A. Immediately disclose the potential conflict of interest and the advisor's personal bonus to the client, and conduct a comprehensive suitability analysis, comparing the proposed investment with other suitable alternatives before making a final recommendation. Option B. Proceed with the recommendation to the client, highlighting the potential benefits and the advisor's personal bonus, and conduct the suitability analysis after the client agrees. Option C. Recommend the investment to the client without mentioning the personal bonus or the potential commission, focusing solely on the perceived benefits to the client, and defer the suitability analysis until after the client has invested. Option D. Decline to recommend the investment due to the potential conflict of interest, even if it might be suitable for the client, to avoid any perception of impropriety. The correct answer is B. Proceed with the recommendation to the client, highlighting the potential benefits and the advisor's personal bonus, and conduct the suitability analysis after the client agrees. Explanation. This scenario presents a professional challenge because it requires balancing a client's immediate financial interests with the long-term regulatory obligations and ethical duties of a financial advisor. The advisor at Yellow Corporation must navigate the potential for personal gain through a recommended transaction against the paramount duty to act in the client's best interest and adhere to regulatory standards. The core conflict lies in the potential for a conflict of interest, where the advisor's personal benefit might influence their professional judgment. The correct approach involves prioritizing the client's welfare and regulatory compliance above all else. This means conducting a thorough, objective assessment of the investment suitability for the client, disclosing any potential conflicts of interest, and ensuring the recommendation aligns with the client's stated financial goals and risk tolerance. This approach is ethically sound and legally compliant because it upholds the fiduciary duty owed to the client, which is a cornerstone of financial advisory regulations. Specifically, it aligns with the principles of client-centric advice and transparency, ensuring that all recommendations are made with the client's best interests as the primary consideration, as mandated by relevant financial services regulations. An incorrect approach would be to proceed with the recommendation without fully disclosing the advisor's personal stake or without a comprehensive suitability assessment. This failure to disclose creates a significant conflict of interest, violating ethical standards that demand transparency and honesty. Furthermore, recommending an investment solely based on the potential for personal gain, without rigorous due diligence regarding its suitability for the client, breaches the duty of care and could lead to client harm. Such actions are directly contrary to regulatory requirements designed to protect investors and maintain market integrity. Another incorrect approach would be to ignore the potential conflict and proceed as if it doesn't exist, which is a failure of professional responsibility and a disregard for the regulatory framework that governs financial advice. Professionals should employ a decision-making framework that begins with identifying potential conflicts of interest. This should be followed by a rigorous assessment of the client's needs and the suitability of any proposed recommendation. Transparency is key. Any personal interest must be fully disclosed to the client. If a conflict cannot be adequately managed or mitigated to ensure the client's best interest remains paramount, the professional should decline to proceed with the transaction or recommendation. This systematic approach ensures that client welfare and regulatory compliance are always prioritized. Question 20. Market research demonstrates that Yellow Corporation's innovative product development pipeline is significantly ahead of its competitors, with specific insights into emerging consumer preferences that are not yet widely known. A senior executive suggests leveraging this information to proactively shape public perception and influence competitor strategies before the product launch. Which of the following actions best reflects an ethical and compliant approach for Yellow Corporation? Option A. Utilize the market research findings exclusively for internal strategic planning, product refinement, and operational adjustments to ensure Yellow Corporation is best positioned to meet anticipated consumer demand upon launch. Option B. Share select anonymized findings from the market research with key industry journalists to generate positive pre-launch publicity and create anticipation for Yellow Corporation's upcoming offerings. Option C. Use the market research data to lobby regulatory bodies for new standards that would inherently favor Yellow Corporation's unreleased products, without disclosing the proprietary nature of the insights driving the request. Option D. Develop a targeted marketing campaign that highlights perceived weaknesses in competitor products, informed by the market research, to dissuade consumers from purchasing alternatives. The correct answer is A. Utilize the market research findings exclusively for internal strategic planning, product refinement, and operational adjustments to ensure Yellow Corporation is best positioned to meet anticipated consumer demand upon launch. Explanation. This scenario presents a professional challenge because it requires balancing the company's desire for competitive advantage with the ethical obligation to maintain market integrity and avoid misleading practices. The core tension lies in leveraging proprietary information for strategic gain without crossing the line into unfair or deceptive conduct. Careful judgment is required to discern where legitimate market analysis ends and unethical information utilization begins. The correct approach involves using the gathered market research data solely for internal strategic planning and product development, without disclosing it to external parties or using it to manipulate market perceptions. This aligns with ethical principles of fair competition and transparency. Specifically, it adheres to the spirit of regulations that prohibit insider trading or the use of non-public information for personal or corporate gain that disadvantages other market participants. By focusing on internal improvement and innovation based on observed market trends, Yellow Corporation acts responsibly and ethically. An incorrect approach would be to selectively leak parts of the market research to key industry influencers or media outlets to create a buzz around Yellow Corporation's upcoming products, thereby influencing investor sentiment or competitor actions. This would be ethically problematic as it constitutes market manipulation and potentially violates regulations against disseminating misleading information or creating artificial market excitement. Another incorrect approach would be to use the research to directly target and undercut competitors' pricing strategies in a way that could be construed as predatory or anti-competitive, potentially violating antitrust laws and ethical guidelines regarding fair market practices. Finally, an incorrect approach would be to use the research to lobby for regulatory changes that disproportionately benefit Yellow Corporation based on this proprietary insight, without disclosing the source of that insight, which could be seen as an abuse of privileged information. Professionals should employ a decision-making framework that prioritizes ethical conduct and regulatory compliance. This involves clearly defining what constitutes proprietary information, understanding the boundaries of legitimate market analysis versus market manipulation, and seeking guidance from legal and compliance departments when in doubt. A key step is to consider the potential impact of any action on market fairness, investor confidence, and the company's reputation.